Hello buddies, I am Shivakumar Lachapeta, a certified equity research analyst, stock market investor and F&O trader with more than 5 years of experience in the stock markets. This video is for beginners in the stock market and people who want to know about stock market investments. In this video, we shall discuss about fundamental analysis and top 4 financial parameters for analyzing a stock. Number 1. Price to earnings ratio. Number 2. Price to book ratio. Number 3. Debt to equity ratio. Number 4. Current ratio. Note: whatever I am suggesting here is only for educational purpose and should not be considered as an investment advice. Make sure you consult a financial advisor before making any investments in stock markets. To almost all new investors and traders, how to analyze a stock is a mystery. There are many parameters like financial ratios, technical trends, candles, annual reports, etc. available for every single stock listed in the stock exchanges. As an equity research analyst, I usually follow the fundamental analysis for selecting a stock. Nevertheless, I also use technical analysis to take advantage of the price fluctuations of the stock. We should be well experienced to use the technical analysis since there is a chance of trend reversing and us ending up on the losing side. Coming to the point, the 4 most important ratios that I use for fundamental analysis. Number 1. Price to earnings ratio. The price to earnings ratio or PE ratio is one of the most important, noticeable and easy measurements for analyzing a stock. It is the ratio of the price of a stock trading in the market and its annual earnings. It signifies how expensive or cheap the stock is trading in the market. I repeat again, it is the ratio of price of the stock trading in the market and its annual earnings. Simply put, it is price of the stock divided by its annual earnings. It is the premium that you are willing to spend on a share in advance for its return every year. Suppose each share has earnings of 10 rupees per year. An investor is paying 100 rupees for it now, then PE ratio is equal to 10. It is recommended not to buy shares with a very high PE ratio compared to industry PE ratio. The shares of blue chip companies trade at higher PEs than mid and small caps belonging to the same sectors. Number 2. Price to book ratio. The price to book ratio or PB ratio is another crucial ratio to check before purchasing a stock. It is the ratio of the price of a stock and its book value mentioned in the company's balance sheet. It also represents whether the stock is trading at a high premium or not compared to its book value or net worth. Net worth is equal to total assets of the company minus total liabilities of the company. I repeat it again. Net worth is equal to total assets of the company minus total liabilities of the company. We get book value of each share by dividing net worth of the company by total number of shares. For example, a stock with price to book value equal to 2 means people are willing to spend 2 times its book value. Software, fast moving consumer goods or FMCG, blue chip stocks trade at high PB ratios compared to PSUs and small cap stocks. Similar to PE ratio, try to buy the stocks with medium PB ratios. Always compare the PB ratio of a share with industry or its competitors' PB values. Number 3. Debt to equity ratio. The debt to equity ratio is the ratio of total debt of the company and the net worth or equity of the company. I repeat it again. The debt to equity ratio is the total debt of the company divided by net worth or equity of the company. It is a solvency ratio that measures the ability of the company to pay back its debt with its accessible balance cash and assets reserves. For large caps, the ratio might be in between 1 and 2. In case of small cap companies, it is better to choose the stocks with low debt to equity ratios. Usually less than 0.5 should be fine. A company with low debt to equity ratio will be able to pay back its debt in tough economic situations without much hassle. Next one, or number 4, current ratio. Current ratio is the ratio of current assets to current liabilities. It is the measure of liquidity, whether the company can meet its short-term obligations like dues and payments with assets that can be converted into cash within a year. I will repeat the definition again. It is the ratio of current assets to current liabilities. The measure of whether the company can meet its short-term obligations like dues and payments with the assets like cash balance and other assets which can be converted into cash within a year. The higher the current ratio, the better the stock is to invest. For small and mid-cap stocks, the value should be more than 1.5 minimum. In case of large cap stocks, the value might be in between 0.8 to 1 depending on the relevant sectors. Similar to other ratios, always compare the values with competitors in the industry. Finally, when we choose a stock, it is important to make sure that PE, PB and debt to equity ratios are lower than or equal to industry values, whereas current ratio should be higher than or equal to industry values. In this slide, I have shown the top IT companies of India. We can see that TCS, being the leader, is trading at higher PE ratio. It is relatively priced higher compared to next 4 companies in PB ratio as well. Debt to equity is great for all the companies in the list. Similarly, current ratio is greater than 1 for every company. All these companies come under large caps. So, current ratio of 1 is more than enough. As a practice, analyze the list and choose in which companies you would invest from the list if you have liquid cash available with you right now. That's it, buddies. I hope this video is informative. If you like the video, share it with your friends. Thank you, take care and goodbye.